Morning, and many thanks to all for joining this morning's briefing on the national accounts and international accounts results for Q3 2021. So that's the months July to September 2021. Microphones are set to mute, as you'll see, as we go through the presentations on today's results. We'll take questions at the end of the presentations, and can I ask people to use the Q&A function, or alternatively, if you want to raise your hand, we can take you off mute and have the question as part of the discussion after the presentations. So my colleagues here today will take you through the quarter-on-quarter results this morning, and we'll also look at some of maybe the year-to-date comparisons for the key aggregates. We felt it's helpful to look at these cumulative comparisons and comparisons with earlier years, given the impact of the COVID-19 restrictions over the past 2 years. So slides from today's briefing will be available along with the statistical releases on CSO website, and a recording of today's presentations will be loaded to CSO's YouTube channel. And as we always say, users can contact us at any stage with queries on the results. Contact details are available on the statistical releases or on the press release for today's outputs. So I'll pass to Chris and John. Chris first, and Chris will take us through the Q3 results for the national accounts. Many thanks, Chris.
Thanks, Jennifer, and good morning, everyone. We have a fairly muted set of results, I guess, today on the quarterly national accounts with a GDP growth rate of 0.9%, reflecting a lot of timing issues around the multinational activity. But I guess keeping it in line with the domestic measures, for example, modified domestic demand, which is up at 1.4%. If we look at our infographic for the quarter, that's the GDP result on the far left, growth of 0.9%. And the modified measure, modified domestic demand on the bottom, up 1.4%. The top of the infographic shows you all the sales or output measure for the economy, and the bottom of the infographic shows you all the money spent, the expenditure method of GDP. Looking at the output method on top, we see industry up 7.4%. The second biggest sector, information and communication, is down 0.2%. The two M&E sectors, and again, both of those are affected by various M&E timing issues in the quarter. And then some of the domestic sectors, construction up 5.1%, distribution, transport, hotels and restaurants also up 5.1%, and a decline in some of the other sectors like the financial insurance activities down 2.7%. So on the expenditure side, we see personal consumption, all the value of goods and services consumed in the quarter, up 0.5%. Government expenditure up 0.8%. Investments down, but we'll talk about that in a moment. And then net exports is also down. Exports are up 1.3%. Typically, we see stronger growth there, and imports are up quite strongly, up 4.5%. So the net exports are pulling down the expenditure side of the figures, giving us that combined result of 0.9%. If we look at the results across time, so this is GDP and GNP across time, and we can see the volatility, I guess, in those series, and the timing issues similar to what we saw in 2020 around Q3 and Q4. But that's our result of 0.9%. The timing issues affect the profit outflow as well. So the profit outflow, or the remitted profits, being lower in the quarter and leading to a higher GNP result of 0.5%. And as we like to do, I guess, at this stage, is look at available peers data. So what other countries have data published at this stage, and that 0.9% puts us kind of mid-table instead of we'd regularly see Ireland at the extremes of this graph, probably on the far right. But lots of other countries' results are heavily related to the restrictions, as we've seen over the last 2 years, I guess, in the data. But Ireland at 0.9% around Denmark, Luxembourg and Finland. So if we look at the output side of the accounts, we see industry up 7.4%. Some of you may have expected a stronger result on industry. Our second biggest sector is down 0.2%, information and communications. And some of that, again, is related to some of the royalty payments in the sector. And then the domestic sector, some of the more domestic sectors, distribution, transport, hotels and restaurants, up 5.1%, and we'll show you some various different pieces of information on that domestic sector through the presentation. Construction's a much smaller sector, I guess, in the economy, construction, but that's up 5.1% as well. While we see some declines then in the financial sector and in arts and entertainment. On our website, you can look at these series over time. In the graphics, you can toggle on and off the series. And what I like to do with that is pick out the four, I guess, that interest me on the M&E side and on the domestic side. So we see industry there in green at the top. And that's the data that people might have expected a little bit more growth, and it's still significant growth in the quarter, quarter three seasonally adjusted. And the information and communications data down 0.2%. And again, I think that's a nice sector to look back over time. And you can see some of the volatility in that around about the end, the second half of last year too. So we're seeing some of that again, I guess. And the two domestic sectors, construction and distribution, transport, hotels and restaurants, growth, much smaller size sectors, but growth in both those, and they're important domestic effects to pick up there. So when we bring all the sectors together on the output side of the accounts, apologies there, I just wanted to look at the monthly data first. Looking at some of the monthly data from our business statistics area, we can look at the industry side and the services side of the account. So just to look at the services side, I guess, in particular, that's quite helpful in interpreting some of those domestic sectors. So the domestic distribution, transport, hotels and restaurant sector is explained quite well by the first three categories here. So wholesale and retail, transport and accommodation that you see there. That growth throughout July and August in particular and into September explains that sector very well. I'm going to show you some wages data on that sector towards the end of the presentation also. So if we sum up then that side of the accounts, the output side, we can look at the M&E dominated sectors growing 4.7%, and the non-M&E dominated sectors growing 1.3%. So that's on the output side. I think that 1.3% for the non-M&E data chimes quite well with domestic demand, modified domestic demand on the expenditure side of the accounts. So turning to the expenditure side of the accounts, so this gives you consumption, what we spend on goods and services, plus government spending, plus investment, and then net exports. It gives you the GDP number there on the black line with the growth of 0.9%. If we strip away again, on the website, you can do this yourself. You can toggle off the M&E related activity, the exports and the investment, and we can build up to the blue line, modified domestic demand. So we see consumption there in the dark blue on the stacked bar chart growing by 0.5%, government expenditure in green growing by 0.8%. And then from the top of the stack bar up to the blue line, that's our modified investment. So investment, as we showed you at the start, is down 3.8%, but the modified investment's up 4.6%. And the difference and how we get to modified domestic demand is we're taking out the globalization factors. And this quarter in particular, it's aircraft. So we take out the effects of leased aircraft, our investment numbers, our modified investment is up 4.6%. Talk more about that, I guess, in a moment. Firstly, I guess, looking at consumption, PCE, fairly broad-based growth across a number of the categories, but I guess goods is up 1.4%, mostly in line with retail sales data, and services is down marginally to give us that overall result of 0.5%. You might see the current price data is up a lot more strongly, and year on year is up more strongly, but the seasonally adjusted, we take all of those price factors into account to get the volume series, and we seasonally adjusted. That's where we get that result of 0.5%. Looking at the data across, again, some of our available peers for this data will expand as the days go on in the quarter. But that 0.5% is on the low side compared to other countries that have available data, again, with the consumption data in those economies related to the timings around restrictions. But I guess it's useful to look at our monthly data for business statistics on retail sales. And this helps us explain the PCE result for the quarter a little bit. So this is also seasonally adjusted data where we can see that the Department stores is a good example. So the data is down in July and September, but up in August. And you can look across the other categories too, various different consumption categories, and see where we come up with the overall result of 0.5% from. Over time, the retail sales is fairly stable, I guess, over the last quarter, adjusted for various other different factors. Cars, motor vehicles always has a large effect on the series. On the investment data, capital formation is down 3.8%. Within that, building and construction is up 2%. The current price data, and many people look at this, I guess, more frequently on the volumes of versus the volumes, and the pricing effects, I guess, is quite strong in the quarter. So when we strip out the prices and come up with this volume number for building and construction, again, seasonally adjusted, it's up 2%. So that explains why that number isn't bigger than people may have expected. Machinery and equipment's down 14.1%, and intangibles are down marginally. With some of the confidentiality restrictions, we can't give out all the figures we'd like to, I guess, on this set of results. But what we can say is aircraft strongly affecting the capital formation data. And we look at the modified capital formation, which the data is available in our annex tables. We can see that modified cap form is up 4.6%. And there's important domestic factors there too. We're seeing continued high spending on computer hardware all the way through 2021. And in Q3, we're seeing continued investment in vehicles as well. So between the two, we're seeing a strong domestic result in the underlying modified capital formation data. And it's a point worth making that the IP volatility that was caused in 19 and the start of 2020 isn't there in the data, so we can do a lot more year-on-year comparisons now with the various different categories inside the investment data. The last element of the expenditure side of the accounts is net exports, and I'll leave this to John. He'll show you a lot more detail on this, but I guess the takeaway for national accounts on the net exports data is probably the high imports. The high imports of services, in particular in the quarter, which is bringing down the net exports number and affecting the overall GDP result. When we break down that GDP result of 0.9% into the component that's coming from modified domestic demand and from modified net exports, we can see that the bigger share of it is with the of the small number is with the modified final domestic demand data, while the M&E activity is held back by some of the timing issues. After GDP, we look at the net factor flows or the remitted profits, largely by M&Es, and with the increased costs in the quarter, there's lower profit. So we've lower profit outflows, giving us that high GNP result of 5% in the quarter. But I think we'd largely stick, I guess, with the GDP number, PCE, modified domestic demand, to avoid some of the timing issues around the interpretation there. So everything we've looked at to date is seasonally adjusted quarter-on-quarter data. There's two other ways. I'm just going to show you the data really quickly. Year-on-year growth rates. So this is before the seasonal adjustment process, I guess. And we're going to look at Q3 21 and Q3 20, and we see this growth in the data. So across a number of series. So GDP is up 11.4%. And if we look down into the consumption and investment side, consumption's up 7.7% on the same quarter last year, with broad-based increases in services mainly driving that data. Investments down on a strong quarter in Q3 20. So they're all year-on-year results. And then the final way, the third way, I'm just going to show you the data is, I think, presents it in a quite interesting way, I guess, looking at the first 9 months of the year, the first 3 quarters for 2021 over 2020. And people's preferred measure modified domestic demand, that's up 4.9% on the pandemic affected 2020. But we compare it then with the pre-pandemic 2019, we can see we're still down 1.2%. So growth on 2020, but we're still not back up to 2019 levels for the economy in terms of modified domestic demand. A similar picture with consumption. While the GDP numbers are pushing strongly ahead, as they have done for a number of years. We continue to develop the series we have on wages or compensation of employees as a domestic indicator for you. This presents the wages or the wage bill for you in the quarter. It is seasonally adjusted, but it's in current prices. Wages make up about a third of GDP, a strong part of the domestic side of the accounts. And the distribution, transport, hotels and restaurant sector, I think, is a good one to draw your attention there to. So the wage bill in that sector is up 14.5%, seasonally adjusted Q3 over Q2. And that ties in very well with what I showed you earlier on the monthly services index, where we can see the various different parts of that sector growing, particularly accommodation through July and August. But you also see the wage bill increasing in construction and arts and entertainment quite strongly quarter on quarter. We can show you how the subsidies, the EWSS subsidies, support that wage bill as well, with the increased subsidies in distribution, transport, hotels and restaurants on the left-hand side of the graph there. So with more people working in the sector, the wage bill goes up, and that's been supported with the EWSS payments. So to sum up for me, going anti-clockwise, I'll start with GDP up the top, 0.9%. The result for that, and looking at the output side of the accounts, we've industry up, the biggest sector, industry up 7.4%. Second biggest sector, information and communication, down 0.2%. Both of those have various timing issues around M&Es. Then we have two big domestic sectors, construction and distribution, transport, hotels and restaurants, both up 5.1%. And then some falls in some of the other sectors, financial and insurance activities and arts and entertainment. And summing up the output side, between M&E and non-M&E dominated data on the bottom of the slide on the left, the non-M&E sectors are growing 1.3%. And that chimes very well with the modified domestic demand measure on the other side of the slide under the expenditure method. That's growing 1.4%. The net factor flows are lower in the quarter because of some of the timing issues around profits, and that leads to the GNP, the higher GNP result of 5%. But roughly, important point to draw out, I guess, is the non-M&E data on one side growing 1.3, and the other side, modified domestic demand growing at 1.4%, which GDP for this quarter is quite tightly in line with that at 0.9%. So I'll pass over to my colleague John Sheridan now to take you through the international accounts.
Thank you, Chris. So now I'd like to take you through the international accounts for Q3 2021. So firstly, we can see our infographic here, which is a good summary of the results for the quarter. So we can see that our goods exports are 72 billion, our goods imports are 27 billion, which give us our balance of 45.7 billion. Our services exports are 71 billion and our services imports are 67 billion, giving us a services surplus of 4.8 billion. And our income inflows are 27 billion and our income outflows are 54 billion, which give us a net income outflow of 27.3 billion. And these all combine to give us our current account balance of 23.3 billion euros or 20.4% of GDP. Our net international investment position is minus 586 billion euros at the end of September 2021. And our stock of foreign direct investment in Ireland stands at 1.1 trillion euros. Looking initially at our headline figure, which is the current account balance as a percent of GDP, we can see now we've had 6 quarters without large IP. So we're getting a much more smooth and stable series, as opposed to volatility we could see in the quarters with large IP like Q2 and Q4 2019 and Q1 2020. So this quarter, we have our current account balance of 23.3 billion euros or 20.4% of GDP. Our merchandise surplus is 45.7 billion, which is up 7.8 billion on the same quarter last year. Our services balance is 4.8 billion, which is down 2 billion on the same quarter last year. And our net income outflows are 27.3 billion, which is a reduced outflow of 2.2 billion on the same quarter last year. And these all combine to give us our current account balance of 23.3 billion, which is increased by 8 billion on the same quarter last year. Looking at the balance over time, again, we can see the much more stable series over the last few quarters. We can see the quarters with the large negative services balances, which are those green bars in Q2 19, Q4 19, and Q1 20. And these are where we signify the large IP imports. We can also see the fluctuation in Q3 and Q4 2020 that was driven by the change in royalty imports between those two quarters. So looking at this quarter compared to last quarter, our merchandise balance has increased by 3.4 billion. Our services balance has increased by 1.8 billion, and our net factor outflows have decreased by 3 billion. And these all combined to give us a current account balance that has increased 8.3 billion on last quarter. Looking at these in a little more detail, we can see our exports of 72.3 billion, which is up 10.9 billion on the same quarter last year. And our imports of 26.5 billion, which are up 3.1 billion on the same quarter last year. So we can see that the increase in the merchandise balance is being driven by increased exports. On the services side, we have exports of 71.4 billion, which has increased by 13.6 billion since the same quarter last year, and imports of 66.6 billion, which have increased 15.6 billion on the same quarter last year. Looking at our primary income inflows and outflows, we have inflows of 25.1 billion, which has increased 1.9 billion on the same quarter last year, and outflows of 51.7 billion, which are down 219 million on the same quarter last year. Looking at the part of these that's made up of direct investment, profit and interest, the inflows are 4.6 billion, which are down 603 million on the same quarter last year, and the outflows are 29.1 billion, which are down 1.8 billion on the same quarter last year. So the direct investment income outflow net has decreased by 1.2 billion, and the rest of the decrease in net income outflows of 2.2 billion is spread across portfolio and other investments. Looking initially at our goods exports and imports, we can see that our Q3 goods exports have increased compared to last quarter and also increased compared to last year, while our goods imports are slightly down compared to last quarter, but are up compared to last year. So again, we can see that the increase in net merchandise is driven by the increase in exports. Examining how this breaks out into international trade, goods for processing and other, we can see that the international trade exports are up very slightly quarter on quarter, up 150 million, and are down very slightly year on year, down 24 million. While our goods for processing exports are up strongly compared to last quarter and also compared to last year. Our merchanting is down compared to last quarter, but is still increased compared to last year. Our international trade imports are down compared to last quarter, but up compared to last year, while our goods for processing imports are increased compared to last quarter and also increased compared to last year. So we can see that the increase in net exports, again, is driven by the increase in exports, but this is predominantly being driven by increases in goods for processing. Looking at the service side, we can see an overall increase compared to the same quarter last year of 13.6 billion. And this is largely driven by the increase of computer services of 9.9 billion. Business services have also increased by 1.3 billion. And within this, we see decreases in operational leasing exports of 170 million. So we can see that the increase in exports is largely driven by the increase in computer services exports. Looking at the import side, we can see an overall increase of 15.6 billion compared to last year. And this is largely driven by the increase in royalty imports of 11.4 billion compared to last year. We also have business services increasing by 2.2 billion, within which R&D has increased by 784 million. So we can see again the large increase in service imports is being driven by royalties and licenses increases. Looking at these royalties imports in a bit more detail, the blue line gives us total royalty imports, while the green bar gives us the amount of royalty imports related to the pharma sector. And most of the difference between the two is related to the ICT sector. So we can see that there's been a quarter-on-quarter decrease in pharmaceutical royalty imports, but a year-on-year increase. We can see here more clearly the fluctuation in royalty imports that we saw in 2020 between Q3 and Q4. And this year, we are seeing a similar effect with increases in ICT royalty imports. However, this is being offset to some extent by decreasing pharma royalty imports. So the impact on the overall level is not as strong. So royalty imports overall have increased this quarter compared to last quarter, and a strong increase compared to Q3 last year is being driven by the increase this quarter combined with the unusually low level last year. Looking at our direct investment income, we can see inflows of 4.6 billion, which are down 603 million compared to last year, and outflows of 29.1 billion, which are down 1.8 billion on the same quarter last year. So again, we can see that the direct investment income outflow has decreased by 1.2 billion, and the rest of the decrease in net income outflows of 2.2 billion is spread across the portfolio and other investments. Looking at the breakdown of these direct investment outflows, we can see that our income on debt is fairly flat as usual. We can see an increase in dividends outflows in Q3, not as large as the increase in Q1, but still sizable. But there's a larger decrease in reinvested earnings, giving us the overall decrease in direct investment outflows. Looking at how these split out by sector, we can see that quarter on quarter, there is a decrease in the manufacturing sector, which is down 1.1 billion. And there's a large decrease in the information and communication sector, down 3.8 billion, which is being driven by the increase in royalties imports in the sector. Year on year, we can see an increase in the manufacturing sector, which is up 1.3 billion euros. But again, we can see a decrease in the information and communication sector, which is down 4 billion. And again, this is driven by the differences in royalty imports between the two quarters, with the increased royalty imports in this quarter and the low level of royalty imports in Q3 2020. Moving to our trade income and our current account with the UK, we can see that the trade balance with the UK has increased by 451 million, and net income outflows have increased by 1.2 billion compared with the third quarter of 2020. The result is a current account surplus of 800 million euros in the third quarter of 2021, which is down 746 million from the surplus of 1.5 billion in the third quarter of 2020. Looking at our financing for Q3, again, we can see low levels of net transactions in comparison to previous quarters. Our direct investment abroad has decreased by 13.9 billion, and our direct investment in Ireland has decreased by 2.5 billion, giving us a net decrease of 11.4 billion. Portfolio investment assets have increased by 50.4 billion, and portfolio investment liabilities have increased by 52.5 billion, giving us a net change of minus 2.1 billion. And our other investment assets have increased by 24.4 billion, while our other investment liabilities have increased by 2 billion, giving us a net change of 22.4 billion. Looking at our net international investment position, it stands at minus 585.7 billion euros at the end of September 2021, which is an increase of 21.4 billion on the end of June 2021 position. We can see that this change is driven by a combination of non-financial companies and other financial intermediaries. And this is largely being driven by multinational activity. So to summarize, we have a current account balance in Q3 2021 of 23.3 billion euros, or 20.4% of GDP. We're continuing to see low levels of IP imports. Increased royalty imports are resulting in reduced net profit outflows, and we're continuing to see the COVID-19 effects in lower tourism exports and imports and lower transport services exports. And now I'd like to pass you back to Jennifer to summarize.
Okay. Many thanks to John and Chris for taking us through the results this morning. And before we open up for questions, we just wanted to draw out some of the key messages and indicators from this morning's results. As well as we start with GDP, it is a whole of economy indicator for Ireland, so it does take in all effects in the economy and covers both the globalized and the kind of the more domestic sectors and effects that we see across the economic activity in the quarter. So GDP quarter 321 on quarter 21, so a quarter on quarter, 0.9%. And Chris and John have both explained here this morning, I think, and have given us insight into the timing effects there, particularly around the high imports of services and in particular royalties there that are potentially impacting that results in the quarter. We thought it was interesting as well to include the year-to-date comparisons for 2020 and then back to 2019 as well, kind of a pre-COVID comparison there. So GDP year-to-date 21 on 20 up over 14%, and year-to-date compared to 2019 up almost 22%. Looking at our modified indicator there, a modified domestic demand, which covers personal consumption and expenditure, government expenditure and spending on investment as well, but excludes the impact of IP and aircraft. Quarter on quarter, we're up 1.4% for that very helpful. I think it's a helpful indicator of underlying domestic demand. Again, the 2020 comparison is interesting. We're up 4.9, almost 5% there on 2020, but still down minus 1.2%. comparison when we look back at the year-to-date comparison with 2019. And then drilling, I suppose, further down into the economy when we look at personal consumption. So what we all spend on goods and services, quarter on quarter up by 0.5%. And we're up when we compare year-to-date with 2020, we're up 4.3%. But when we go back to 2019, we go back to the pre-COVID results, still down 7.1% for that comparison there.